Hi everyone, buyer's agent Jay Pace here from Providence Property Group with a special market update for the month that was April 2022. Usually I jump straight into the numbers and the performance, but today we first need to address the elephant in the room, interest rates. On Tuesday, the 3rd of May, the RBA increased the cash rate by 0.25%. This is resulting in a new cash rate of 0.35%. This is the first time that the cash rate has increased since 2010. The RBA noted in their financial stability review that a 2% cash rate is their goal between now and 2024. The last time that cash rate was over 0.25% was in March 2020, as you can see here on your screen, and we were at 0.5% at the time. And the last time that we were at the RBA's current target of 2% was in 2016. Now, the RBA also commented that a 2% cash rate could result in house prices falling by 15%. Before the cast of the Today Show tell you to go running to your underground bunkers, I thought it's important that we all had a tall glass of reality. Firstly, I want to remind everyone that banks don't just lend people money based upon current rates. Banks have risk regulation, which obliges them to stress test your loan and every other loan they do. On your screen, you're going to see a media release that came out in 2021 from the Australian Prudential Regulation Authority, or APRA, instructing the banks to assess new borrowers' ability to meet their loan repayments at an interest rate that is at least 3 percentage points above the loan product rate. Previously, the risk stress rate was set to 2.5% above the current rate. So the RBA is talking about a 2% rate rise, or a 2% cash rate, from the average 3% that you're currently at the moment with your loan. So that means that to qualify for a loan, you had to meet the bank's stress test requirements at an average of, let's say, 6%. But everyone's worried. Secondly, in 2020, when people thought that the world was going to end, they stayed home and they saved money. The latest data shows that residential property borrowers have saved a record $232 billion in offset accounts. This is an increase of actually nearly $30 billion in the past 12 months, and that's going to help reduce their interest repayments and shorten their loan terms. So please, don't freak out. We've been here many times before, and the media does the same song and dance. The last time was in 2020, when almost all of the experts unanimously agreed that the Australian property market was certainly going to crash. But it didn't. In front of you is a screenshot of a video that we did in April 2020, where we again explained the fundamentals of why the property market won't crash. I recommend that you revisit the video on our YouTube channel when you can. In the extremely unlikely event that property prices do drop, we've actually calculated 3 different correction milestones. Going off of the scenario proposed by the RBA and using CoreLogic's numbers based on where national housing values were at the end of April 2022, I also expanded this to show a 10 and even 5% correction. Now, I'm not going to read through all of these numbers. Take your time, pause the video, screenshot it, have a look at it later. But if we focus on the most expensive and populated capital city in Australia, being Sydney, a 15% drop in values would take house values back to levels similar as March 2021, not that far back. While a smaller 10% drop would see values at levels similar to June 2021, and a 5% drop, we'd be back to where we were in September last year. You may have heard me say many times before that there are markets within markets, and unsurprisingly, these scenarios play out very differently across capital cities. In markets where housing values have been rising faster, such as Brisbane and Adelaide, a 15% decline would take housing values back to, let's say, July, August last year. While in Melbourne, a 15% drop could see values at similar levels that we saw in 2017, because Melbourne has not moved very much, and they were hit the hardest by coronavirus in regards to their lockdowns and population exiting Melbourne itself. Or in the case of Perth, probably take it back to where it was in 2009 levels. So it's important to review those. I want you to ask yourself this very important question. What if they are wrong? Just like they've been time and time again, This graph tracks the gradual fall in interest rates since 1986 and shows that it has been accompanied by steady rises in Australian median house prices over that same time. There certainly is a strong correlation between falling interest rates and rising property prices, but does this mean that the reverse is also true? How can we be sure that if interest rates rise, property prices will fall? Well, if we look at this chart, in the last 35 years, property prices did not fall when interest rates rose. The RBA has also pointed out that non-performing housing loans comprised only 0.9% of the mortgage portfolio at the end of last year, which is below pre-COVID levels. Additionally, almost all the borrowers who took advantage of lenders freezing loans during the pandemic are back in line with their repayments to schedule. Furthermore, APRA data on a quarterly residential property exposure also highlights that the portion of outstanding loans, about 30 to 89 days past due, was sitting at a recent low of 0.4% through the end of 2021. That's half of the portion reported in March 2020. So these low numbers imply that borrowers are entering a period of rising interest rates from a relatively strong foundation. There's not a lot to worry about, people. Now, due to the distribution of housing ownership in Australia, most of our property owners are immune from interest rate hikes. And I'll show you why. 1/3 of housing is fully owned with mortgages having been paid off with no remaining debt. Another third of our housing stock is owned by investors who can claim the cost of housing finance interest against all their other income through negative gearing. And this means that interest rates rise, it actually reduces the amount of income tax that they're going to pay. In addition, they can also raise the asking rents on their properties to recoup the costs of any interest rate rises. And we're expecting definitely rents to increase. 1/3 of our residential properties have mortgages which are being paid off by owner-occupiers. Now, most of them, however, purchased their home many years ago when rates were much higher than what they are today, and their financial situations have most likely improved since then, and they have probably paid down some of their debt, so a rise in interest rates is quite manageable and does not really motivate those people or force them to sell their homes. Now, higher interest rates are going to impact purchasing power of potential first home buyers more than any other buyers. And that's because they need to borrow most of the purchase price. And this graph shows how the number of first home buyers in housing finance loans fell in 2012 after the last interest rate hike. So we're expecting a similar thing to see the amount of people, first home buyers, applying for finance is going to drop. Some highly leveraged recent first home buyers in new outer suburbs, first home buyer areas, they may experience a bit of stress here when interest rates do go up. But if enough of them are forced to sell for a personal or maybe family, financial or employment reasons, and a number of those potential first home buyers also fall, well, there is a risk that property values in first home buyer locations may fall. When I say first home buyer locations, I hope you understand what I mean. First home buyers are capped at a particular price point where the benefit of being a first home buyer really goes away. So they're all trying to buy at those lower price points, which means they're all buying further out from where the majority of people are typically buying. First home buyers only compromise around 1/10 of all homeowners, and despite the personal and social impacts of such events when they've occurred in the past, such as increased rates, local markets have always bounced back into growth within a few months. Now, I'm always fascinated by the past. It always gives me a better perspective of my present. And I wanted you to take a very high view comparison of the costs and the income from median dwelling values. And I went back to 1990 and I'm showing you now 2022. So let's have a quick look. So sticking to Sydney, the median dwelling value in 1990 was $152,500. I know if we only had time machines, we'd all go back and buy more property. Now, interest rates at that time were 13.5%. And I'm sure you probably paid it back then, or you know people that paid it back then, and they said it was difficult because that was about $20,587.50. Now, if you were renting that property out at the time, you were getting about $275 per week, and times that by 52, we're looking at $14,300 a year in income. So the holding costs versus the outgoings for that would be $6,287.50 would be your holding cost for that asset. Now let's compare it to today. The median dwelling value as at the end of April 2022 in Sydney was $1,127,723, with an average home loan rate of, let's say, 3% or $33,831.69 per annum, and receiving $507 a week or $26,361.88 per annum, results in a holding cost of $7,469.81. So do you want to know the difference between holding a property in 1990 versus 2022 based on the change in price point and interest rate? $1,182.31. Now, residential real estate still underpins Australia's wealth. These numbers are actually a few weeks old now, so I would definitely expect that residential real estate is above $10 trillion. Look at where our outstanding mortgage debt is on the right-hand side there. So our properties are worth over $10 trillion, but our debt's around $2 trillion. So our loan-to-value ratio is still what most experts would call conservative. The latest Hedonic Home Value Index numbers show the top 3 growth capitals for the month were Adelaide, Brisbane and Canberra. In Sydney, we're seeing continuing decline incrementally, resulting in a 0.2% drop in prices. Over the past quarter, that's 0.5% that it's already dropped. Still, not a big number. Last year, it did nearly 28% increase. Hobart dropped by 0.3% and Melbourne prices are staying flat. Now, look at this growing buffer that you've got here that we had last year in annual change in dwelling values. If interest rates do go up and property prices drop, that's our shield, okay? That's going to protect us. You're going to remember this chart from last month's market update that showed national averages on the far right-hand side there at 70.27% increase over the last 10 years. Sydney did over 100%, and it looks like there's plenty of road left in high-yielding capital cities like Brisbane, Adelaide, and Perth, and we definitely are starting to see a lot more interest in those areas. Of course, you need to be cautious. When you're buying in some areas, get professional advice, read, research. We encourage you to do that research. But generally, those people who I speak to that say to me, Jay, we're just going to wait and buy after the market pulls back, or we're just going to see what happens after the election. These are the same people that didn't buy here, 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 and here. Okay? It's very important for you to understand this. It's not timing the market. It's how much time you spend in the market that actually counts. And if you look at any chart, any graph, you'll see that that's correct over time. These are for long-term holds. We don't buy and then flip in a year or two's time. These are long-term investment holds. Now, I think that this could be one of the best buying opportunities that we've seen since 2020. And you may recall this slide from last year's September video when I mentioned that the price gap between median house and unit values in capital cities showed that housing values were sitting about 34.4% higher than unit values. Well, I predicted at that time that this gap would close as the waves of people buying in regional areas started to dissipate, and we'd start to see a bit of a shift back of people who were seeking space and then coming back to seeking place. Now, in last month's video, we discussed how for many Australians, the dream of owning your ideal home is dead, okay? And rental yield will become a major factor in purchasing moving forward. CoreLogic's monthly unit market update actually shows that the annual performance gap between houses and units fell to 8.7% in March, as both markets slipped further from their peak growth rate that they recorded in January. Now, here are the latest figures on houses versus units. Houses are in the red, units are in the orange. And as I said previously, yield will become a major factor to buyers. And we can see rental yields and price points continuing to be more attractive in the unit space, and also the entry price points as well. Now, as usual, the media's done a great job keeping everyone scared of buying units, but the narrative can only last so long. Aussies are being priced out of the house market and don't want to move tens of kilometers away from everything that they know. So they're going to start buying more units. It's just going to happen. We've made our stance on units very clear over the years. We prefer land, okay? We prefer houses. But If it comes between buying a house in an inferior location / suburb to buying a unit in a superior location / suburb, you should consider the unit. Now, coming off the back of strong annual growth, affordability continues to be a key factor affecting market conditions. Amid higher inflation and the rising costs of living, prospective buyers are finding it harder to save for a deposit. While the amount required for a deposit has also increased, assuming let's say 20% deposit levels, the average house deposit has increased by approximately $36,000 over the past 2 years, while the typical unit deposit has only increased by $15,000. Increasing investment in higher density dwellings has a significant role to play in alleviating affordability concerns because higher density housing is generally more affordable. Additionally, increased housing density across key transport lines can help maximize the efficiency and the use of infrastructure. While national houses are still recording stronger value growth compared to units, houses have also recorded the fastest decline in the pace of quarterly growth. Since researching a cyclical peak in May 2021, the pace of quarterly house growth has actually recorded a 4.9% fall compared to the 3.8% fall that we saw for units. Similarly, the slowdown in values can be seen in the annual growth trends shown in the figures of the chart that you can see right there, with both houses and units moving into a bit of a downswing trend after recording a cyclical peak in January. Now, at a national level, total listings remain well below the average for this time of the year last year and over the past 5 years. As high sale volumes have seen around 1.2 sales for every one new listing that's added to the market in recent months. So compared to the same time last year, we've got 13.6% less stock than we had. And compared to the same time over the past 5 years as an average, we're at 32.3% below what we've seen over the past 5 years. Now, I hinted at an upcoming online presentation on the metrics of the property cycle. We've locked in dates for June. We'll be conducting 2 live sessions, a lunchtime session and on the 14th of June and an evening session on the 15th of June. During these sessions, founder and head of research Simon Harris and myself are going to be explaining how the property market will perform and what to expect within the next 1, 3 and 5 years. How we use knowledge of the real estate cycle to buy better when buying a home or investment property, how to pay off your home loan in half the time or less based on some pretty amazing strategies with debt recycling, how to buy an investment property that will outperform the market. Now, we're going to have quite a few people coming to these events. We always get asked for them. You must register if you want to attend. So watch your inbox for an invite, and if you're not on our list, shame on you. Make sure that you contact Providence directly and one of our staff will make sure that you get an invite sent to you. Let our professional buyers agents help you. For almost 2 decades, Providence have helped Aussies locate, assess and negotiate their ideal home or investment property Australia-wide. Stop procrastinating and contact us today. If you like the YouTube page, if you are happy with what you've seen here and you want to see more of that, make sure you follow us on Facebook as well for more updates on the market. I want to thank you for your time today, and I will see you all next month.